Hi, everybody. It's 6 o'clock. Can you hear me? Hello?
Yes, we can hear you.
Okay,
Yes.
good. Uh, so as we do, there are about, I would say, 7 students so far. So we'll wait for a few more minutes to, we should have close to 19 today, or maybe 18. So I'll wait for a few more minutes and I'll come back.
Yes, sir.
We have 13 students now, so I am not going to wait any longer. I'll get started. It's about 6 minutes after 6 o'clock. So we have waited long enough. And good evening to all of you. And as I do every class, I'll request you to be on video because, as I said, it definitely improves interaction. But again, it's optional. If you have any difficulties or hesitation, I fully understand. And as we will be doing every class, we'll start with how the market has done. The NASDAQ did very, very well today, excepting my favorite stock, Microsoft. It fell again today, but we are not actually looking at it from a valuation perspective. We are looking at it from options and options trading. So I will go there in a second. But in the meantime, let me take a look at the sort of like the how are we going to go about it? And let me share the screen with you. And let me put the recorder on. By the way, I did post the
This
recorder.
meeting is being transcribed and summarized.
I did post the recorder. I hope all of you had a chance to look at it. If you did not, then you will definitely have the opportunity later on. But if you have looked at it, all right. I did check all of the recordings before I post it, and it looked all right and quite audible to me. So I don't know. Can you hear me clearly today?
Yes.
Okay, good. So again, I see that only one of you, in addition to myself, are on video. Leah is, but to others, thank you, Cliff. To others, please consider that. That will be very, very helpful. So here is the. Let me share. Here is the roadmap, and as I told you yesterday, that I may not be able to get to all of it today, but all of the option material definitely will be covered by the middle of next class. So we have actually covered most of these definitions and terminologies, basic properties of options, and then the variables, leveraging with options, option strategies. We have talked about some of them. I will talk about a few more, and then the put call parity. And from put call parity on, this is all valuation. So what we are talking about right now is fundamentals and strategies. Now, from the market's perspective, it is the fundamentals and the strategies that are more important, because the two models that we will be looking at, the Black-Scholes option pricing model and the binomial model, many people in the market, they all know about it, but they may not actually follow it, which is absolutely fine. We will not be going through the derivation of the Black-Scholes option pricing model, but we will go through the derivation of the binomial model because there is some economics here. And that I will definitely cover in great detail. And that will definitely. Now, one of the questions, actually, two students wrote to me, which I thought was too early or too soon, as to what's the structure of the exam and how many questions in the exam. To be honest with you, I do not know at this point, because my exams are more case oriented. As I said, it will be group exam. Now, because the 6th class and the 7th class are widely separated. If I give you the exam on the 7th, when our last class, I think, is around 26th or 27th, I don't remember the exact date, that's more than a month away. And you are likely to forget some of the material. I said likely because maybe not. So what I am going to talk to the program is that I will actually give you most of the exam, let's say around 10 days or 7 to 10 days of the final class in this series, meaning the sixth class. On the 7th of July, I will give you a case that you will have to basically analyze in class, both of which are actually going to be group tests. That way, when you come back on the 7th, you will have to remember the material, but you don't have to remember everything. So 75% of the grade, by the way, I have control over 60% of the grade, and Vladimir will have control over 40% of the grade. I am responsible for the final grade, which I will, of course, take both of these into account. But my 60%, if you take that as the whole exam, 75% will be the exam that will be given to you around 7 to 10 days after the 6th class is over. And I may actually have a review session, brief review session before the test. Then the 25% will be on the case analysis on July 7th. That way, I will be able to make sure that you are not under pressure to remember and be prepared for everything on July 7th. I thought that will definitely help the class. So when you come on July 7th, you do not have to remember everything. You only have to remember and know the area on which that case will be. And I will tell you ahead of time. Now, I will possibly give you access to the case from the Harvard course pack, and I will tell you that this is the case that you will have to buy. And I will try to get it to you at a discounted price. Now, one of the questions students always ask, one student has already asked, do I have to buy the course pack? The answer is absolutely yes. I think what the group may be thinking that, okay, one of us will buy it, the others will copy it. I don't need to know that. As far as I'm concerned, all of you should have all of the cases. How you get it is your business. Is that fair? Does everybody understand the exam process?
Yes.
Okay, very good. 75% on the material that we are discussing, that will be given. I don't know the date. I am hoping that I will be able to negotiate the date with the program before next week. And then 25% on a case, which will be given to you maybe a day before July 7th. Of course, no collaboration or among the students, no discussion, absolutely none. And I completely trust that you will not do that. So this is based entirely on trust. I expect that the groups will not collaborate with each other through email, individually or as a group, for the material exam as well as for the group exam. Rather the case exam. You don't have to worry about the case exam right now, simply because I myself do not know which area it will be and which case I will give you. Choosing the case from Harvard is not easy, because I have to make sure that the material is well aligned with what we are discussing here. I have to make sure that the case will definitely be sort of fair, given the material we have discussed. It's not easy to find the right case. So at this point, I do not know the case. However, many Harvard cases tend to be long. So I will give you the case maybe a day or two before July 7th, so that you have time to read it. And you will, of course, not be given the questions. The questions will be given to you when you come to the exam. Is that clear? Okay, all right. Any other questions about the housekeeping issues? I hope not. So I'm going to get to the material now. And just to refresh your memory, what did we discuss yesterday? We discussed long call, we discussed short call, we discussed long put, we discussed caller, but we did not in detail discuss short put. Meaning, what is the trading, or what is the position underlying a put that you have sold. Now, as I told you last class, just basically flip the long position. Remember, the long put is an obligation to sell. So somebody tell me, what is a short put? Well, let's look at the options quotations. I should have it here. Here at the Microsoft. Can you see it?
Yes.
Yes.
Okay, very good. Very good. So I'm going to change this to November 15 once more. Now I'm trying to go at a reasonable pace, but as you can tell, I'm already behind. It doesn't bother me simply because I don't want to shortchange any easy material. This is complicated material. So I am definitely not going to fast pace this thing because the foundations are very important. So let's go to November 2026 options as we did last class. And now I'm going to go to put options. And you are going to be selling a put option on Microsoft. What is your underlying position? Can somebody tell us? Remember, long put is an obligation, or rather a right to sell. What is a short put? Somebody?
The
An
obligation
obligation to
to
buy.
buy. Yeah.
Obligation to buy. That is correct. Now, remember, if it is an obligation, you cannot exercise that at all. That means that somebody has the right to sell the underlying stock Microsoft to you. So if you are under obligation to buy, let's say that you are actually, let's say, these are puts, I believe. Let me make sure, yes. So if you are selling a put option, the first thing with respect to options is to identify why are you doing this? What is your expectation with respect to the stock price? Now, I think Peter said obligation to buy. What must be your expectation so that you will actually sell a put option?
The underlying assets price will go down.
The underlying asset price will go down. Okay. Now, the stock price today is around 405. So you are thinking that, well, the way it is going, it's not too long before it may go down to 375. Right? Is that what you're saying?
Yeah, assume it will go down.
Okay, that's fine. So, can you tell me, remember, when you are talking about options, several things you have to specify. What is your stock price expectation? What exercise price are you going to choose? And which maturity or expiry? Now, in this particular instance, I'm not asking you for the expiry because I already told you these are November 29, 2026. You have to tell me which exercise price you want.
Again, I am the buyer of the put.
You are the seller of the put.
Oh, okay. Sorry. Then I changed my mind. If I'm the seller of the put, then I assume the price will go up, so I won't be executed on the. So the price won't go down. So I don't need to. Yeah. So I don't I don't need to buy that position because the price will go up, and then the other side who's long on the put is not going to sell it to me, not going to exercise the option because it can sell on the market. Sorry, I
Okay.
talked with
Yeah. So you are saying that I do not expect, if I let me repeat, that I do not expect the market to go down. So I will rather sell a put option. Can you give me an exercise price?
Just a second.
This is a question to the entire class.
Yeah. I would say like probably 380.
380. Okay. You sell a put option at 380 and get roughly $23. The minimum number of options that you have to sell obviously is 100. Always remember that an option contract is a contract on 100 underlying shares. So you're going to get $2,200 immediately, $2,300 roughly. That's pretty good income. Now, what is your risk, Peter?
The risk is if it goes down.
Notice the questions I'm asking you.
Yeah,
So
the
in the
risk is
exam, I will tell you that if you are going to be or I will say that, well, let's say you are selling Microsoft November 20 put option at 380 exercise price, and 2287 times 100 is your income. Then my question will be, what is your risk?
so the risk
Because
would
your return, I'm sorry, let me give me one more second. Your return or income is already known. You're not going to make any more money. You already made $2,300 and that's about it. Now the question is, what is your risk?
so my risk is if the underlying assets price indeed goes down, and let's say goes like 350, then actually have to buy that
Very
those
good.
underlying for 380, so I'm losing $30 on each stock, meaning like
Exactly. That's very good. So notice what will happen to you if the market crashes. So who will actually sell put options? Somebody who is thinking, no, Microsoft will not drop anymore. Now, you are absolutely correct, and thank you for answering. Realize that if you sold, if you got more greedy, let's say you got more greedy, Peter, and said, no, Microsoft is already at 405. It's not going to go down anymore. Let me sell some put options at 400. You realize what will happen to you if now Microsoft will possibly not go down to 350 tomorrow. Let's hope not. But even if it goes down to 380, you are under obligation to buy it back at 400. So a lot of people before the last market crash sold tons of put options on the S&P 500 index. And the market crashed. You can imagine that many of them got wiped out.
sorry, which market crash are we talking about?
So around 2008, 2000, all of those large market crashes, mainly actually the 2000 last internet crash, it seems like many years ago, as a matter of fact, it was. But remember the party that the market was having. I remember that in 2006 or so, I was in New York City at an alumni meeting, and that day the market had gone down about 10%. One day. It all seems like history. Of course it was. And by the way, all of you must have noticed that after President Trump announced the tariffs last April, almost immediately after he became president for the second time, that day, if you had actually bought that day you would have made 15% return by now, maybe more. I don't remember exactly. So that is the type of market crash I'm talking about, where all of a sudden, for no economic reasons at all, market goes down just by the knee-jerk reaction. I don't remember exact number, but I think I will not be surprised if that day itself, or over a 2 or 3 day period, the Dow Jones Industrial Average lost 2,000 to 3,000 points. Now, of course, it has recovered since then, but pay close attention to these individual positions. Long call, short call, long put, short put. Every other strategy is a combination of these four. Every other strategy. So before I pass to combinations, does anybody have any questions?
I have a question.
Go ahead.
Can you explain one more time what Peter was saying about losing $30 per?
I will ask Peter to explain that to you.
Sure.
So go ahead, Peter, and speak a little louder. If anybody else wants to join and add more insight, that is fine. So the question, Peter, is that I will make it a little more extreme, that Peter has sold 2 contracts, let's say. Two contracts on Microsoft put options, exercise of price of 400 and November 20 expiry, and made $31.40 on each one. So roughly about $6,200 on that particular sale. So explain, Peter, what is your expectation and what happens if before November 20 drops to $360?
So
That's exactly the type of question you can expect on fundamentals in the test.
So normally of the buyer of a put option, then you expect that the underlying stock will go down. So if it goes down and you are bought that, so you are the buyer of that put option, then if it goes down like from 400 to down to 350, that means then other side who is selling that put option has to buy your positions, like each option contract 100 underlying stocks, meaning it has to buy 100 Microsoft stocks at 400 when the market price is $350, meaning the other side who is selling that put option is actually losing $50 on each stocks, meaning if sold one contract, option contract, that 50 times 100, $5,000 it will lose. The person who is bought that put option contract then actually will gain $50 or each underlying stock, meaning 50 times 100, $5,000.
So the point here is that if you are selling a put option, you are under obligation to buy the stock back at the exercise price. So if the exercise price is 400, then if the stock goes down to 350, then as Peter pointed out, people that are on the long side of the contract can force you to buy the $350 stock at 400. So that's what I was saying, that a lot of people who were just enjoying the party of the stock market sold put options on the market, thinking that the market can never go down. And then the market crashed. And when the market crashed, they were all forced to buy that particular index back at a significantly higher price and just got wiped out. So
maybe just one additional thing. So when the market is not so volatile, that strategy selling that put option is maybe a good bet, because there is a less chance the price will go down, but the market is volatile, and if there is a crash, then the risk will increase and you can lose a lot of money.
Well, you see, Peter, the point here is that if the market is not volatile, you said, and of course, as we saw with respect to Microsoft, the market volatility particularly in the downward direction, has taken the sleep away for a lot of people, including myself, that I just don't know what is going on. And I talked to my analyst friend today again that what the heck is going on with Microsoft? I can't figure it out. He told me the same thing that he has been telling for months, that there is nothing wrong with the business model. See, if there is nothing wrong with the business model, something has to be wrong that the market does not like. No one has been able to figure out. The problem is that Microsoft has delivered so well for so long that people are still sticking with it. I am just hoping that the turnaround comes soon, because if this negative sentiment about Microsoft continues, then it will hit very, very hard the people that are in the stock market. Because Microsoft, by definition, is the number one stock in almost all mutual funds in the world. There is no question about it. Absolutely no question. This stock has been the biggest pillar of the market for a long period of time, almost 30 years. And I'm not making it up. As I told you earlier, that if I bought just about 10,000 shares of Microsoft 30 years ago, I would not be sitting here today. Even with this 10 to 15% drop that we have seen in this year alone, and the continuing drop in the market. So the market cannot figure out what's going on here. And the CEO has failed to basically appease the market. So anyway, that is a valuation question. We don't want to get into that. I am going to now get into my slides and quickly go through them. So Leah, you followed what we discussed?
Yes, thank you.
Sure. Okay, we have gone through all of this. Definition of the option: buyer holds right, but not the obligation. Call option, I'm just going to skip all of these definitional things. This is expiration date. What are the difference between American and European option is important. American option can be exercised anytime before expiry. Everything that we are discussing is American options. European option exercisable only at expiry. Option value example. For example, in Intel stock at 56, these are actual numbers, but of course, these numbers are not valid today. By the way, all of you know that Intel gave you a return of nearly 150% in the last month and a half. I don't own Intel. Anyway, Intel stock at 56.78, December 55 call at 378, value is 387.50, which is 378 times 100. That is the contract of 100 shares. Exercise requires $55 payments. Why? 55 is exercise price, 5,500 for 100 shares. In the money means stock price exceeds exercise price. Out of the money means stock price is below exercise price. Remember, out of the money. So let me just go back to the quotations once more. Let's take call option. You know that the options in blue are in the money options. So let me take this $390 option. Roughly stock price was around 405 or so. It closed at that. So at the closing price of 405, what is the intrinsic value of this option? 390 exercise price. Remember, intrinsic value is the stock price minus exercise price for call options. What is the intrinsic value of this call option? Very easy.
Around $17.
$17. Why? 407 minus 390. Okay. Now let us go to a out of the money option. Let's take this $440 exercise price option. What is the intrinsic value of this option?
0.
Exactly. The intrinsic value of this option, you might be tempted to say is, oh, 407 minus 440, roughly $33 negative. No. Intrinsic value cannot be negative. Intrinsic value is either 0 or positive. So all out of the money options have intrinsic value of 0. This is explained here. I'm not going to, so obviously here you will see things like implied volatility, delta, theta, which I have not discussed. Later on, you will understand this. So payoff of the call holder, as I just told you, 0 and S minus X. S minus X is the intrinsic value. Here is the long call. This is called a hockey stick diagram. I'm not going to spend too much time on it. I am sure those of you who have ever been exposed to an option class have seen this. What this diagram means is that up to $100, which is the exercise price in this particular case, the option has no value because it is out of the money. Why is it below 100? Because that is basically the value of the option. And because of the value of the option, you will lose that much if the option expires with a stock price below the 100. Above the exercise price, that means above 100, the stock price and the option price will move in tandem. That's what this diagram shows. Actual movement of the prices is not this. So this diagram does not, repeat, does not show the actual value. It shows the value of the option when it has expired. So, and this is the short call. Notice that on the short call, you lose heavily if the stock price goes up. Why? Because you will be under obligation to sell. So if you have sold a $100 exercise price call option, and if the stock price goes to 150, you will be under obligation to sell the underlying stock at 100 when the stock price is 150, so that you will lose $50. If anyone has any questions, please feel free to stop. Put option definition, we have already gone through that. Notice that it has been flipped X minus S because put option goes downside, protects downside. Here is the diagram. Notice that it is now flipped, and the downside then is where you get when the stock price is below the exercise price, that's when you make money on the left-hand side of the diagram. Leveraging with options I will do later on. Long put, I just explained to you that was this previous slide is a little misplaced, but the diagram that I showed you is actually long put. This is the short put. Notice that on the you lose money if the stock price goes down, as Peter was explaining to us. So contrast this picture with this picture. Notice that on the long put, you make money on the downside. On the long side, you make money on the downside of the stock. On the short side, you will lose money on the short side of the stock. Here is the short put. Now, basic properties of options. These are the 6 things option values depend on. And there should be a diagram right here. And this diagram or this particular picture is taken straight from the case. I will show you the case. The most important are the top 5 characteristics. Notice that the stock price, the time to maturity, volatility, we have talked about volatility a lot, of course, and risk-free interest rates all have a positive contribution to the value of the call option. The only one that has a negative contribution is the exercise price. Now that makes a lot of sense, because if the exercise price is higher, that means that you will have to pay more for the option. And of course, the option value will actually, rather more for the stocks, so the option value will be lower. Everything flips when you go to put. Now, there is a question under time to maturity for put option that is a little difficult to follow. So that you will actually have to read. I have explained it. If somebody has a difficulty, I'll come back and explain that to you. In the next two slides, I have actually explained why the effect of volatility on a European put option is positive. So you will actually have to read that before now.
Sorry, just one question on the previous slide. The distribution means dividend, right?
That is correct. I'm sorry, I did not mention that because you say so. Let's actually focus only on the American call because that's what is of interest to us. Quickly, can somebody tell us why is the effect of dividends? Because you know, effect on dividends on stocks is strictly positive. Why is the effect of dividends negative on options?
Because if the dividend is paid, then the stock price will go down, meaning the option price will also go down.
Exactly. Thank you very much. Dividend is a part of the value of the stock. So when the dividend is paid, it means that a part of the value is gone, which is why it has a negative effect on the option. That if the company did not pay the dividends, then that will be actually embedded in the stock price itself. There are still many, many companies that do not pay dividends. I don't remember if Google does, but you know, two of the best performing stock of the top 5 are Google and Nvidia. I doubt if either of them pays dividends. Microsoft does. Microsoft, unfortunately, as I have said many times, is the worst performing stock of the big 5. It pays dividends, not very much, but it does pay dividends. So dividend payment will have a negative effect on call options, positive effect on put options. Why? That is simply because the dividend erodes the value of the underlying stock. Now I will go into something that is very, very important. This one is, think about it this way, that there are two different distributions shown here. And one is a left with gray, or rather sort of yellow, and the other is a right with a blue. So calls depend on the right-hand side. Strike price equal to 100. The shaded area marks outcomes contributing to the call option. Now, what that is saying that, and this is something that we can understand better by going back to the going back to the quotations. So let's look at the quotations once more. Now I am going to explain this with call options. So let's say that you buy these 380 call option. I have to make sure these are call options. Yes, they are. 380 call option today for $53. You can look at the enormous, because as you know, the intrinsic value of this call option is 407, 180, which is $27. The value of the option, or the market price, is as high as $53. Now, let me ask you the following question. Very simple. If the price of Microsoft stock, let's say you buy that option today, if the price of the Microsoft stock, hopefully it will go up from now on, who knows, on November 20, 2026, when this option will expire, is 430. How much money will you make on this call option? If the price of the Microsoft stock on November 20 is 430, how much money will you make?
Would you have
At this
broken
point,
even?
I'm going to look at the class and I'm going to reach out to, let's say, Julia, let me reach out to you. I don't see you, but can you hear me, Julia?
Hear you.
Okay. Can you answer this question? That if you buy the $380 exercise price call option today, how much money will you make? Not net, but gross. How much money will you make on November 20, 2026 if the stock price is 430?
Can you go back to your screen, please?
Then I will have to share again. Do you see that?
Yeah, I can see it.
$380 stock exercise price. Current stock price is 407. Stock price of Microsoft on November 30 is 430. How much money will you make? Will you make any money?
No. Right?
Okay, okay. But let me ask you the question by part. What will be the intrinsic value of the stock, or rather the option at
Mhm.
that time? Huh?
So it was 420, you said?
430.
430, so the intrinsic value, would that be 50?
That is correct. So let's just say that let's not worry about the price because you have already paid for it.
Uh-huh.
So what I was trying to get at is that you will make $50, right?
Right.
Okay. What happens if it goes to 475? You don't have to answer that, but you know that you will be making more, right?
Mhm.
Okay. Now let me flip this and say that if the stock price happens to be 360, how much money will you make?
If it goes to 360,
360, yes.
so you'd lose money,
You make nothing
right?
because you are not going to buy the stock at 380 when it is selling for 360, right?
Mhm. Mhm.
What if, yes, you wanted to say something? Go ahead.
Oh no, go ahead.
Okay. Well, you may be thinking of the price you are paying today. I'm saying ignore that. In net, you are absolutely right. You will lose. But the point is that you are not going to be losing more than the 53.20, 52.25. What happens if the stock price goes to 300? Same answer. I'm not going to do anything because the option is expiring, worthless. Correct?
Yes.
Okay. So the point is, if the stock price goes above 380, you will make money. And for every dollar that it goes above 380, you will make $1. Similarly, on the other hand, if the stock price goes below 380, it does not matter anymore what the stock price is, because the option is worthless for any stock price below 380. Does everybody follow that?
So
Any questions?
Yes. Yeah, but actually, if it goes like 430, then and you pay the premium for that option,
I'm
like
not talking about the net
$53.
terms. Yeah, sure.
so
I'm not talking net terms. I'm talking about intrinsic value.
I see.
Point is that on the upside, you have a one-on-one correspondence beyond price, right? You have a one-on-one correspondence with the value of the option and the value of the stock. On the downside, there is no correspondence at all. That once the stock price has gone below exercise price, it doesn't matter what the stock price is. So the call option derives its value entirely from the right-hand side, not from the left-hand side at all. So the left-hand side of the distribution does not matter, not at all. So we talk about volatility and everything. Remember, we are talking about volatility on the right-hand side only, not on the left-hand side. So only the right-hand side of the distribution matters. So this picture is with a sigma of about 10%. This picture is with a sigma of 25%. So the point they're trying to make is that this option will have greater value. This is the exact flip side for put options, where the blue shows that the put option value derives from the left-hand side of the distribution. That means the downside risk, not from the right-hand side. Exactly the same thing. Okay. I'm going to skip upper and lower bounds. This is what upper and lower bounds are. I will come back to that if time permits at a later point of time. Now I am going to talk about one of the most famous arbitrage relationships in the stock market. It's called put-call parity. Now, this was discovered around 1973, more than 50 years ago today. What this is telling you is that there is a relationship, arbitrage relationship between a call option and a put option, but not any call option and any put option. And this can be derived, but this is not a class for theoretical derivation, so I'm not going to actually get into it. I am going to get into the application of this particular relationship. So C is the price of the call option. P is the price of the put option. And as I said, this is not just any pair. This is a pair of a call option and a put option on the same stock, the same maturity, and same exercise price. That means that this particular, and on the right-hand side, or you have the stock price minus the present value of the exercise price. X is the exercise price, and X over 1 plus R raised to the power T is the present value of the exercise price. So this fraction, do not read it as S minus X. Read it at S minus X over 1 plus R over T. So this is basically, to avoid confusion, you may want to put parentheses around it. So now let us actually translate this formula to plain English. C is positive. That means that is a long position. E is negative. That means that is a short position. I can flip this around and I can write it any which way I want, but it means that you have a long call and a short put. If you take the difference of the values or prices of these two, they must equal stock price. And this amount is minus, that means this is borrowed money. Minus means you are not long on the treasury bill, but short. That means that you have borrowed the money. Everybody should understand that when you are buying a treasury bill, you are basically lending money to the federal government. They are selling a bond and you are actually lending money to them. On the other hand, when you are going to the bank and borrowing for your mortgage, that's a short position. So, long call minus short put must equal the stock price minus the present value of the exercise price. Now, it really doesn't mean anything until you know what to do with it. So, I'm going to show you an example of exactly what it really means. But before I do that, let me go to the quotations once more, and let me show you that what are the two possible, options for which it will actually work. So let's say that I am actually buying a 300 or a 400, a $400 call. I'm buying it as a long call. 42.85 is the price. And in order for me to create the put call parity arbitrage, I actually have to sell a $400 put and go to 400 here. And the $400 put is 31.40. So 42.85 minus 31.40. So roughly about $11 is on the left-hand side. That must be equal to the stock price, which is equal to 405 today, minus the exercise price is 400, present value of that exercise price over the next 6 months. What it is saying that in a options market, this relationship, which is a no arbitrage relationship, must be satisfied. Otherwise, you can trade to make some profit. And this, of course, I mean, if this were a more advanced class, I would explain how this particular, the mechanism of this particular model, but we don't really have to do that. We have to look at it from a trader's perspective as to whether the trader will constantly be checking as to whether this is the model that can be used to detect relative underpricing in the options market. Now let me explain what I mean by the relative underpricing. For that, I will take you to this particular example. And let's say that I'm going to take you here. And notice that all of the details are given. NVIDIA options, 11/20/2025, so roughly about 6. Stock price was 184.50. NVIDIA has moved up a little bit since then, not a lot. Roughly, I think it's about $212 or so. This is an option that is actually expiring tomorrow. But at that point of time, notice that it had roughly 6 months left. 11/20/2025 to time to expiry. This is T, 5/15/2026. RF is this, as I told you, risk-free rate. R is the risk-free rate here, and T is the time to expiry. Remember that both the risk-free rate and time to expiry must be in the same unit. That means that if you are using the annualized risk-free rate, then T must be expressed in years. You cannot write the risk-free rate in annualized form and T in the number of days or number of months. You cannot do that. So going back to the example once more. Now I'm missing, where was I? Not this one. I have so many different things open. Yes, okay. No, this is slightly different. I'm sorry.
Yeah, it's the one with the table.
Hold on. Option, my goodness. Because I kept all of them open so that I could actually switch. Sorry about that. Can you believe, I think I've opened everything, but I cannot find the one I'm looking
That
for.
is it. That is it.
Give me just a second. I just got distracted. I have too many things open. Put call parity word. Yes, this is the one.
This is it.
Was it? Right?
Yes, that is it. Yes, that is it.
Yes, it's
Okay.
this one.
Thank you. So RF, notice that I have actually made it 6 months. It's not exactly 6 months because 1120 to 515 is not exactly 6 months, but I have rounded it to 6 months. So remember that the result we are going to get is not going to be precise. And T-bill yield to maturity is 3.68%. Those of you that have taken classes from me before will know where we can get this 3.68% 6-month treasury bill yield. If you do not remember, I will show you. So let's go to, let's go to wallstreetjournal.com. And in the Wall Street Journal, we will go to, this is of course big news, as you can tell, that Kevin Warsh will be the new Fed chair, and market seems to be pleased because the market was down, up nicely today, but mostly NASDAQ stocks. Dow was, several Dow stocks actually lost money. This has been one of the things that has been going on in the market for quite a while, that Dow and NASDAQ are not in sync. They are almost negatively correlated now, which has been a puzzle for a lot of different people, because if you really think about it, that these IT companies or tech companies are really service companies. They are actually servicing the Main Street industry. However, when these industrial stocks, I should not say industrial stocks, even JP Morgan was down substantially today. American Express was down. Who are these IT companies selling to? So that has been a puzzle as to why there is this correlation. It's so negative. In any case, so I'm now going to go to markets and finance. And in markets and finance, I'm going to go to bonds and rates. And under bonds and rates, here is the 6-month treasury bill. Notice that it is 3.73%. That means that when I took the number 6 months ago, it was 3.68. It is 3.73. It hasn't really moved that much. Now I need to find the this is absolutely unkind. It should not be doing that.
Is it third? Third from your left. From your left. No.
I think you are right, and I found it.
Yeah. This. No. Not that one. Yes, that one.
Okay. Now, one of the things I want to point out too is this number, sigma. And by now, you know, this is the most important number in the valuation of options. Somebody tell me what this represents.
The
5
volatility.
factors. Yes. 5 factors: stock price, exercise price, time to maturity, risk-free rate, finally, volatility. Of the, not of the option, but of the underlying stock. Now, volatility is definitely the term. How do we measure it? Edward, what is the measure of volatility?
The measure of volatility is the standard deviation or the changes in the price of the stocks.
Stick with standard deviation. That is the correct definition. Yes.
Yeah.
Standard deviation. But you still haven't completely answered that question. Is it daily standard deviation, monthly standard deviation, or annual standard deviation of returns? What?
Yeah, that is the daily standard deviation, and then you can annualize it.
Okay, that is good. That is good. If you say daily standard deviation annualized, I will accept it. But correct answer would be annual standard deviation of stock returns. You can derive it from daily. However, stick with the annual. Okay. Does this number look high, 49%? Remember, Microsoft is 32%. Does this number look high?
Very high.
Exactly. Very, very high. Now, this number, this table actually is very helpful. Why? Because it gives you the market price. Now, these market prices are taken on 11/20/2005, so do not try to check them. But these strike prices are definitely still there. You may go and take a look at it. Tomorrow will be the 14th. Just take a look at the market prices of these options. Remember, this is a strike price. This is the market price of options. So this is basically, remember, this is C. Okay. Stock price was 184.50. So intrinsic value is $14.50. Market price of the option or market value is $34. So $20 is the premium. Okay. Then the next one, 230 and 100. $230 call option is out of the money. That's why it is in red. Similarly, $100, $20 put option is out of the money. That's why it is in red. Notice that I have taken pairs. 170 call, 170 put, both expiring on 5/15/2026. And I've given you what are the intrinsic values. Now, this column here, you will not actually follow. You will not follow that. Why? Because actually it is an option calculator, which I may not show you tomorrow. This is where the calculator will calculate the Black-Scholes option pricing price for you. I may briefly show you today so that before tomorrow's class, you come prepared for it. Volatility. Now, that is something that is a very, very important term. Some of you may be familiar with it. So I am going to ask, does anybody know what implied volatility means? Let us keep these numbers, these three terms in mind: implied volatility, delta, and theta. Let me go back to the class. Who is familiar with the term implied volatility of an option? Because I already gave you the volatility, it is given 49%. And just take a look at that particular document, that you will see that the implied volatility is slightly different. What is implied volatility? First, let me ask, has anyone heard that term? Does that sound familiar at all?
Yes.
Okay, Leah, can you explain? Do you remember?
From what I do remember, it's like the market's estimate basically of how much a stock will move.
That is correct. That is actually correct. But how does the market estimate that?
Inferring it from the option price.
That is correct also. And what model actually was used to derive that implied volatility?
Oh, that I don't remember.
Okay, somebody else?
Yes, Black-Scholes.
The Black-Scholes.
That is correct. That is correct. Black-Scholes option pricing model was used to actually derive that implied volatility. I'll show you. It's very, very easy. What is delta? Delta is by far the most important characteristic of an option. That is correct. Delta is the relative movement in the price of the call relative to the stock price. That tells you that if the stock price moves by $1, how much will the price of the call move? Theta is the same thing with respect to time to maturity. Not that exciting. Delta is the definitely the most important, and the other one that is important are possibly gamma and vega. And I'll give you definitions of those. These are not something that you have to calculate. I will show you a website that will automatically calculate these for you. Automatically. So let us go back to that particular put call parity, and let me share that. So notice that these numbers, 48 and 45, are very close to this 49, but not exactly the same. Delta is 0.678. That means for every dollar movement in the price of the stock, the NVIDIA option will move by roughly 68 cents. The other thing that I will point out to you is that notice that theta is negative. What it means is that with every passing day, the price of the option will automatically drop. Now, I'll ask you to think about that as to why that is the case. Why is the theta negative? Now, let us see what we can do with this data. So it says consider the 170 call and put options. Remember, as I told you, they have to be the same exercise price. Of course, they are the same time to expiry also. What is the implied annual risk-free rate according to put call parity? So we know C minus P is S minus X over 1 plus R T. So 32.95 is the price, 16.20, all of that taken from the, it doesn't exactly match, does it? No. I don't know why I have used different numbers. So that means that when I took those numbers and when I took these, they were different. It should not have been, because the notice that the stock price also is different. It's not, it was 184, so the stock price also dropped, but the basic idea is the same. And then 176 is the number of days left to expiry over 365, converted that to year. And then R is what I am actually trying to determine. 6.68% is the risk rate, much higher than the risk-free rate here, 3.68%. Much higher. That means that there is something not quite right about this pair of calls and puts. Now, if I give you this particular type of thing in the exam, obviously you will be using the prices here. Why these prices are different? I have another document that I will go to. Maybe the prices are the same there. But then the question is that what do I do with this 6.68%? So the question is, now notice that now these numbers are even more different. Why? Because I'm going to X equal to 230 and X equal to 230 calls and puts. So now I'm using the risk rate, check the prices of X. So check the prices mean that C minus S and all that, I'm going to be calculating the using these numbers. Call price is 9.50. So the put price is 9.50 minus this thing, 49.28. Something wrong there. Oh, not quite. 49.28. And the market price is 52.65. That means that that put option is overvalued. This number, market price, is much higher than the number implied in the put call parity. Which means that if this is overvalued, then you really should be selling the put option.
Sorry, Professor, how do we know the put option is overvalued and not maybe the call options price is not correct?
We don't know. I am taking the call option price to be correct. That's why I said this is all relative. I can I can work out taking the put up, because I cannot take both of them to be wrong. Actually, both of them may be wrong, but I can definitely decide that, okay, I will take the call option price to be given and correct, and take the put option price as mispriced, see which direction it is. You can flip this particular example, and you will possibly see that the call option price is either overvalued or undervalued if the put option price is correct.
Yes,
That's
Professor.
the whole purpose of this thing. Yes, go ahead.
Yes. So basically, the put call parity definition that is mentioned here from some other textbook that I read is that the equilibrium, if they are equal, the two sides are equal, that is the equilibrium price that should be maintained, that which no arbitrage should be allowed.
That's exactly the point. Yes.
Yeah. Okay. So
Notice
if one
that,
side,
here-
if one
Edward,
side is
let me
greater,
just
yes, sir.
let me just add something.
Okay.
Remember, we have ignored one of the most important things in the market here, which is transaction
Yes.
cost.
Yes.
So transaction cost will make sure that this is not exactly matching, but it does not
Okay.
matter,
Okay.
because even if it does not exactly match, if the mismatch is because of transaction cost, that means there is no trading opportunity here.
Yeah.
But if the difference is actually 52.65 and 49.28, which is roughly 6%, that's possibly much higher than the transaction cost.
Okay. So my next question that I wanted to ask is that if the other side is higher than the other side, then that brings in for an opportunity that we are
Yes.
talking about. Yeah.
Yes.
Okay.
Yes.
Okay. Thank you.
What maximum percentage you would consider as a transaction cost?
Well, that I cannot really answer. I'm sorry, because it all depends on who you are. And usually, transaction cost in very active options like NVIDIA or Microsoft is not very high because the volume is so high. Now, the difference here is more than $3 on 50, so roughly 6%. That definitely will be a trading opportunity. There's no question about it. Absolutely no question. Because remember that this type of discrepancy will not be tolerated in the market. So the trading will immediately start, and the trade by the trading, it will make sure that the arbitrage opportunity is removed. While you are thinking about it, I have another example of put call parity. Let's take a look at that one. Here, this is actually the theoretical framework. This is number 4. I've numbered them so that you can actually, okay, so this is another example. This is also from November 12. Look at the price of Microsoft. You see that? $100 it has lost in the last 6 months. So 20% it has lost in the last 6 months. That is one of the worst performing stocks in the market. In any case, strike price is 500. And this is also a May 15, 2026. That means that this particular option must be still trading. And TE I calculated was 0.50. Call premium, that means the call price. Notice the price here. So people that bought this particular call option for $49 are very, very sorry today. Very, very sorry. They have lost all their money, period. But if you sold it, you must be smiling to a party today. That, wow. So in any case, and remember, if you sold this particular call option, then you may not actually be that sorry today, because the stock price, as we know, is 407. So on the stock itself, you have lost more than $100, but this call has covered you up to $50. So remember, one of the things that the covered call will do for you is protect you from the loss on the stock. So one of the questions that you might be asking yourself that, well, I have downside risk. Should I buy a put option or should I sell a call option? Did everybody follow what I said? I don't want to talk too fast. Did you follow what I said? That if you sold this call option, you would be smiling today. Anyway, and the put, remember the same exercise price, put 29.42, T-bill maturity 182 days, and T-bill yield to maturity is 3.79. All of this is taken from the Wall Street Journal. Application of put call parity. Let us hope that I did not mix up the numbers here, and looks like I did not. And X over all that. Therefore, the right-hand side of the parity expression is S equal to S minus X, 20.34, and this is 20.41. Notice that they are almost equal. And that's what it should be. So the observed market differential between the call and put prices of 20.41, while the theoretical no arbitrage differential impact is 20.34. The small discrepancy per share indicates near perfect consistency with put call parity. Such a minor deviation is well within the normal market bid-ask spreads and transaction cost boundaries, as I was telling you. So this particular example is better. And this is precise. The previous one was is precise also, but I mixed up the prices. This one is perfect. And as you can see, if here, going back to your question, Peter, if I took the put call price to be given and the put price to be the mispriced one, you will find out that the put price from the formula and the put price in the market are almost equal. That means that there is no trading opportunity there. And that's the way it should work. Unless all of a sudden the stock shows too much volatility. That's when this particular relationship could be violated for a very short period of time. That means that what that can cause this particular relationship to be violated is excessive volatility. That means that the market cannot figure out. Any question?
But probably trading algorithms who are checking these discrepancies, probably like high frequency trading, probably
Absolutely.
equalize the difference very quickly.
Oh, of course, because remember that everything in the market is actually programmed. That you cannot exploit these arbitrage opportunities by trading yourself. You have to program the computer that is constantly checking for these relationships. And you can also instruct the program to trigger a trade and then you will see that when we talk about fixed income arbitrage as to how to trigger these trades. That means that you will have to tell the computer that if you see the discrepancy exceeding a particular percent, that's when you start buying and selling. That means that one of these will be overvalued, the other one will be undervalued, and you start trading accordingly.
Yes, Professor. The put call parity, is it applicable to both American and European option or just the European option?
No, it is applicable to both, but there has to be an
Okay.
adjustment for the fact that American options are much more flexible. That means that for the same features, the American option will be a little more valuable than the European option simply because you can exercise the American option anytime.
Yes.
Otherwise, the relationship should hold, yes.
Okay, thank you.
Any other questions? Okay, let me now go back to my slides once more. And I will now start talking about some of the combinations. These are examples, basically the same example here, so I'm not going to go through that. You'll see all of this here. Now, option strategies. And immediately at the very top, we have covered call. Covered call, as I said, is one
Professor,
of the,
you need to share your screen.
sorry, I actually did not share, so let me share. Okay, so I'm not going to go through this. As you know, this is a covered. The difference between a covered call and a naked call is that in a covered call, you own the stock. We have talked about this at length yesterday. And we just saw an example where the price of Microsoft has dropped more than $100. So if I had sold that call option in November, I would have been compensated for some of the big losses I've suffered. And here is the covered call. This is basically combination of long stock and short call. Collar also we have talked about. Collar strategy is long stock. That means you already own the stock. You sell the put option and you buy the put option and you sell the call option. Now, basically, if you own the stock, your problem is the downside risk. Best way to understand this is to look at the quotations. So let's say that we go back to the option chain once more. Now let's say that somebody owns, as I told you, 10,000 Microsoft shares. And given how it has performed, he's very, very worried about the downside risk. So he tells his broker that I do not want the value of my portfolio to drop below 375. It's very easy. The broker will tell him that you immediately buy put options with exercise price of $375. So let's go to the put options, and 375 put option is right here. $21. I'm sure these are put options. Yes, $375 put option is $21.25. Now you realize that if the executive wants protection for 10,000 shares, this is going to cost a lot of money, because 100 of these will cost him $2,000. And he's going to say, oh, hold on for a second. That is a ton of money. And the broker will have to say, yes. That's when he will say that, you can actually offset some of this cost by selling a call option. So what call option does he have to sell? If he wants his investment to be as low as possible, then he will look for a call option which has a value close to $20. So let's see what call option will satisfy that. Notice that there is a $22 call option at 450 or more, even closer, at $455 exercise price. He can sell a call option at 20.95. And the executive says that is excellent. Because this strategy, where I'm selling I think it was $375 put, rather buying $375 put and selling $455 call option, costs me nothing. I'm willing to do that. What does this strategy do for him? Long put at 375, short call at 455, both, let's say, 1 year maturity. This is 6 months, so we can go to a 1 year maturity very easily. You may want to write it down and explain to me. Hold on. So what you want to write it down is that 10,000 shares of Microsoft at current price of 405. He wants protection at 375. So the broker is saying buy $375 put options, which was something like $22. Then he complains about the cost. The broker says fine. Then you sell this $455 call options for 20.95. He will be happy because his cost is near zero. Now, if you have written it down, my question to the class is explain what happens on this strategy. Say that again, Cliff. Can you speak a little louder? Exactly. At what price? $455. Correct? So what you are saying is that he's giving up all of the gains above 455. Am I correct? Okay. In exchange, you are getting protection at 375. Right? That means your value of Microsoft is bracketed at 375 on the downside and 455 on the upside. Now, whether the executive will like it or not, I cannot tell. But my point is that you can play around with these two exercise prices until the executive is happy.
Actually,
You
one
might say,
question.
yes, go ahead.
So let's see, the price goes up to 455, meaning I have a, I saw the call option, meaning I have obligation to sell at that price those my Microsoft positions. So I kind of limit my gain at that price, but I understand marking timing is impossible, and definitely I cannot right away buy back at that price, but probably maybe I can buy back like 457 or 460. So practically I don't really see too much downside. Like
Very good point. Yes, excellent point. Yes. That is exactly what I tell people when they say, oh, I'm missing all of the upside. I said, no, just go ahead and buy again. Not at all.
and plus I still have actually the downside protection.
Absolutely.
Because that's not exercised. It's still active.
So the point here, Peter, is that, and you will see that in the diagram. Now that you understand, I'm not going to go through these prices. You can see here is the upside, here is the downside.
We don't see that. You're not sharing, sorry.
Oh, sorry. Here is the collar strategy. An inverted Z. Lots of executives will do that because they are fully protected on the downside at the price they want, with the sacrifice of some of the upside. Look, I mean, 407 to 455 is roughly $50. So you are already talking $10 of gain. I will gladly take it. Had I am not trading options right now. Had I done this in November, it would be very pretty for me. So, of course, I don't own anywhere near 10,000. If I did, I would have considered it. But the point is that, I mean, of course, Microsoft executives do. They have these kind of things because otherwise their exposure is too much. So a collar strategy is very, very important. This is clearly a risk management strategy. That you are fully protected on the downside in exchange of sacrifice of some of the upside. The question really is, how do you bracket this thing? And that's your choice. All right. Now, bull spread. Okay. Here is the bull spread. Looks like a V. This is a long put and a long stock. Now, the beauty of this thing, notice that you will make enormous amount of money if the stock price is very, very volatile around exercise price of 100 and about 100. This is also a very popular strategy. And there is a short side of it, this also, which I will show you. This is called a straddle. That means that you are straddling both sides of the stock price. V actually will become very, very useful when you are expecting tremendous volatility in the stock price, but you don't know which side. It can go up very fast or it can go down very fast. Now, you might actually wonder, does it really happen? Is there a point of time when we are expecting very high volatility, but the direction is a little ambiguous? And it does happen. Anybody can guess? Say that again. That is a very good point. Yes, very good example. Another one would be when the company has become a target for a merger and you don't know whether the merger will go through or not. That means there is uncertainty on both sides that if the merger goes through, target price will jump. If the merger fails for some reason, target price will fall. And so I will agree that earnings is a very good example. A lawsuit can be a very good example as well. As you know, that many tech companies get involved in lawsuits where they could lose a lot, they can gain a lot. And when the outcome is announced, stock prices move. So this is a situation for extreme volatility. And remember that here you are actually investing in both at the same time. So this is a very expensive, particularly if it is a very, very volatile stock, this will be a very expensive strategy because you are paying for both put and call option. And if the stock price does not move, then you are dead. You are going to lose all the money. So this is definitely far more risky than the collar strategy. Collar strategy, you are not going to lose a lot. You are definitely not going to gain a lot. That's the way it is designed. Here, the only way you will gain is if the stock shows extreme volatility on either side. No volatility around its exercise price will kill you. The strangle is a little different. This is a combination. Now we are getting into more complicated strategies. So I have to allow you time to actually look into that. Butterfly spread, I am not going to go through all of this today. So let me now go back to the topics. So I have not covered leveraging with options. I will actually cover it before the class is out. Put call parity we have, and I have covered some of these put collar straddle and all that short call. And right now, I will briefly introduce option valuation and try to cover that after we come back from the break. For that, I will actually open this particular case, note on option valuation. And this is a two-state option pricing model. I will introduce this and then take the break. This binomial model takes the time to expiration for an option and breaks it down into a number of time intervals. I'll explain all of that, what it means for all steps between the options valuation date today and first node. and its expiration date. For each time interval, a week, a month, a year, it is assumed that the price will move either up or down. That's the basic essence of this model. And there is a very simple example here. And the beauty of this thing is the following, that this is a one-step binomial model where the exercise price is 100, and it can either go up to 120 or go down to 80. And the question is that if it is a call option with only these two possible values of the stock one period later, then what is the value of this call option today? Let me repeat that if we assume a simple world where we know that the stock price can only go up 20% or go down 20% in the next period, and if the call option price is exercise price is 100 on a stock that is also $100 today, so that the intrinsic value is 0, what is the value of the call option? Now you realize that if the stock 80, the call option is worthless because the price of the stock is below the price, so it is worthless. Whereas if the stock price happens to be 120, then you know that the call option will be worth $20. But the problem is that as of today, you do not know which one will happen, whether it will be 20 or whether it will be 0. Now, one of the things that you can actually assume or think about is that, well, do I need to know the probability? Actually, you don't. What you will see after the break is that you really don't need to know the probability at all. We can actually consider this to be a delta neutral, meaning probability neutral model, and derive the value of the call option. And also, when you go to the two-step, meaning that 2 periods, of course, it will become a little more complicated. But what people have done, of course, with computers, as you read, that they have actually broken up the time period into innumerable steps and allowed the computer to actually backtrack the value of the option from that, and the value that has been derived is very close to the value of the stock, or rather value of the option, because the probabilities will determine what is the likelihood that it will be 120 and 80. The implied probabilities will definitely can be derived that way. So after the break, I will go through the textbook in this case example, and then if time permits, I will definitely finish the leveraging part. If time permits, I'll talk about the convertible and the Mogen. If not, that will be taken up next class. So at this point, I am going to take a break. It's about 7:45. We'll come back as we did last time, exactly in about 15 minutes. I'll come back again at 8 o'clock. So I'm going to stop the recorder. We have 16 students today, 15 students, so I'm still losing 4 of you. By the way, remember that I told you that you need to give me the names, if you want to, of the group comprising of 4 students each before next class. So if you do not give it to me by this week, then I am going to form the groups myself. I have received the group from one of the students, but I will possibly ask all the groups submitted again before the next class. So let me come back around in about 15 minutes or so, and I'm going to put this thing on mute, and I'll see you in about 15 minutes. All right, folks, I'm back. And I hope you can hear me.
We can hear
had
you.
16, actually, no, more than 16, I think. Maybe 16 before we went on the break. I have 15 at this point. We may have lost one. But I will, it's 8 o'clock, so we'll get started. Let me put the recorder on. And we were talking about the two-state option pricing model. And I have been told that Yakov described this model and went through this model in great detail. Given that, I see no particular reason to waste time on it. I will possibly give you in the exam definitely a model like this. However, there is a different scenario in which this model can be used, which is a completely different scenario from options. But at this point of time, we are going to stick to the valuation of options using this model. Remember that the model can be used for both call prices and put prices. So if there is no questions on this model, then I will assume that the students are very familiar with it. There is no reason to take class time to discuss this. But before I move on to the next topic, I will give the benefit of the benefit to the class to ask me any clarifying questions. Now, of course, the students will be responsible. Let me open the case that I was looking at. And let me share. I want to make sure that I am actually on the model itself. And because I do this by hand. I usually go with a two-state model, which is this one here. In fact, this one I have already solved and I have posted. So if you need any help with this model, you may actually look at my notes and go through that, but I see no particular reason to go through this model in class. Then there is, of course, in this particular case, there is the Black-Scholes option pricing model. This is the put option, of course. This is put option, which is basically the flip side of the call option. But if you are not comfortable with it, to take a look at it. Binomial tree can be calibrated. Calibrated meaning it can be taken to an innumerable number of cases. But here is the Black-Scholes option pricing model that we will not be deriving, but I will show you how to actually use the Black-Scholes option pricing model with real life numbers, as well as the website that I find to be most useful. And let me take you to that website right now. Let me see. Here is the option calculator that I use. And this is already posted for you. The CBOE is the Chicago Board of Options Exchange, but a more useful one is this one. So I'm going to go to this one. And okay, this is free actually, but this is very, very friendly and very useful. And you can definitely use it during the exam. There is no question about it. And the beauty of it is that you just have to put in the ticker symbol, and it will pick up all of the information from the market. So I'm going to go with, let's say, Microsoft again, because that is the stock we are looking at. So just put in MSFT here. Now, before I go any further, could you access this website? Did anyone try? Hello?
Yes, I didn't try, but I'll try.
Please do. I want
I
at
tried.
least.
I can access it.
Oh, good. Very good. Okay. So as soon as you put in Microsoft, you will notice that it has already picked up its price. And we can check market prices. So it has a call option. Expiration is 2000. I don't want that one. So let's go back to the Microsoft chain and take any option for that matter. And let's take a at the money option. At the money means that the stock price and the exercise price are exactly the same. So let's take the 405 at the money option. Remember, the price is 39.65. And let's make sure that this is November 20, 2026. And we will go here and find the November. Why isn't it working? Okay. November 20, 2026, right here. And strike price is, we don't want 405. I thought we said 400 is what we really wanted. Let me make doubly sure that I'm looking at the 400 option. Actually, I can take the 405 also, but so I'll take the 405, which is about $40.65. So 405 strike price. Notice that it has already taken the number of days for you. You don't have to do anything. And volatility is 32.37%. Now let us go back to the Microsoft Corporation and notice that here it is 35.19. That means that the number that they have taken, 32.37 is the actual volatility that they have calculated. Dividend yield is 0.85%. That can be easily found from Yahoo. Is everybody okay so far? Do you follow?
Yes, sir.
And then notice that given this number, it has already calculated a theoretical price of $40.57. Now the market price of this particular option is $40.65. So notice $40.65, and they have calculated $40.57. So that should tell you how efficient the market is. Now, why is this so friendly? Because, I mean, I have used many other. You might take a look at the CBOE also. This is the easiest and the friendliest way of finding the theoretical price of the option, given all of its characteristics. The other beauty of it is that it also calculates what it calls the implied volatility, meaning that what is the volatility implied in the stock price, or rather in the option price. That if you really take the market price of the option, then the volatility that is implied here is 34.36%. So everything that you need to know, delta is 0.57. That means that if the stock price moves by $1, this particular option is going to move by 57 cents. Gamma and vega I have not defined, so I'll have to define those. But gamma has to do with the volatility itself, that if volatility changes, what happens? And theta and rho is the interest rate. Theta, as you know, is the time to maturity. So those of you that have tried this, very, very powerful, very friendly, and pretty accurate, and it's free. So this is the one that I will be using when I go to, I mean, if time permits, obviously I'm going to get into the convertible bond option valuation, because we now have time. But there also, I will be using this particular website. And as I said, the beauty of it is that you can easily change which particular stock you want. You can change call or put. You can change the expiration, and one specify the stock. Once you specify the type of option and the expiration and the exercise price, the rest of it is immediate and very simple. Anybody has any questions? Does it say European only? It doesn't. If it doesn't say that, this should be American. But it says Black 76 option pricing model, which is different than the binomial model used for the CMOL's volatility and Greeks page. You know, I mean, there is really not much difference between the European option and the American option. Let me explain why that is the case. Now, let me go back. I think it was Cliff saying that this is applicable for European options. It could be. It doesn't say that explicitly. But as I told you, the difference between an European option and an American option is that European option can be exercised anytime. Cannot be exercised anytime. It can only be exercised at expiry, but an American option can be. But now let me ask the class a question. And for that, I will go back to the options chain once more. Let me take that same 400 option. I will share in a minute. And let me see how the class answers this question. So let's take this 405 at the money option. At the money option means that the stock price and the exercise price is exactly the same, almost exactly the same. So I think that Cliff was saying that this is for European options only. So let me go to Cliff first. So Cliff, would you exercise this option right now? Okay, okay. I cannot make it any bigger, but I will read it to you. I am old too, Cliff. You don't have to apologize for that. That's absolutely fine. So let me then. Sure, absolutely, absolutely. But you will soon find out that there is another angle to this question. But because you are having difficulty reading it, I can see that Edward is on the screen. Edward, can you read this? Can you read the details of the 405 option? Okay, if you cannot, let me read that back to you. 405 is the exercise price. You may not be able to tell, but that particular group of options that are in the money or at the money almost right now is in blue. This is not quite at the money, it is slightly in the money. The option price is $40.65. I tell you, you must do something with this option right now. So what are the choices? One is you exercise the option. Two, you sell it. So Cliff, let me repeat the question to you. This is a $405 exercise price option, which is almost at the money. And it is currently priced at $40.65. I am telling you that although this is expiring on November 20, 2026, you must do something with this option today. And the choices are obviously you exercise it, or the other obvious choice is sell it. What will you do, Cliff? Exactly. Because if you exercise it, you are going to get only 17 cents. If you sell it, you will get as much as $40.65. So what it is said that an American option will never be exercised before its expiry. Why? Because the market value will always exceed the intrinsic value. So it really does not make any difference. The American option, although it can be exercised, will never be exercised before its expiry. Does everybody follow what I'm saying? Edward, did you follow? I'm asking you because you are on the screen. Cannot hear you. Let me go to the class.
Oh, my mic was muted. I said I can
Okay.
hear you.
Okay.
Yes, sir.
Let me go to some people that have not spoken at all. Carlos, can you hear me? Carlos? I don't know if you can hear me.
Oh,
How
yeah.
about, okay. So Carlos, do you follow what we have? Can you explain why a particular or any American option will not be exercised before its expiry, whether it is call or put? Unless, of course, if it is a call option and you are saying, I insist that I must have the American Microsoft stocks right now. If that is not the case, then you will never exercise the call option before its expiry. Do you understand why? Carlos is mute again. Gokul, can you hear me? Gokul? I don't know if he can hear me. How about you, Matthew?
Can you hear me?
Okay, can you hear me?
Yes.
Do you follow the question?
Yes. It wouldn't it's you're asking why no matter the European or American, why you wouldn't exercise it before expiration?
Why an American option? The European option cannot be exercised before its
Oh, yeah.
expiry anyways. Why is
Yeah,
it that you will not exercise an American option before its expiry?
because of the time value of money.
Because you can sell it at a higher price at any point of time, which is basically the time value of money, yes, and the volatility. That you are always better off selling the option than exercising it. Why? Because the market value will always exceed the intrinsic value because of you, as you said, market value, time value, and more importantly, volatility. Yes, thank you. Now, I don't know if everybody can hear me or not, but the real issue here is I can try to determine, Cliff, whether that formula the model is useful only for European options, but my point is that the difference will not be that significant because for all practical purposes, they are equivalent. Okay. Now, does anybody have any questions about the website?
Professor,
Yeah.
I have one question. Wouldn't it matter though for puts? What if you actually
Would it not matter for puts?
would it matter
Question.
for puts?
Why? Why? Good question.
Wouldn't it be because if you sell it, you get the money right away instead of using the money?
Well, you think about that. I'm not going to answer it.
Oh,
Good question. Good question. Yes, good observation. That the time value of money may actually work the other way around. Well, that is something that I think the class needs to think about. Go back to the table I showed you. See which way the time value of money direction is with respect to puts. And come back and we will explain that. We'll discuss that. So now in the time remaining, I am going to go to this case called Mogen Inc. For that, I have to open it. I have not done that. So hold on for a second. And this is definitely one of the most widely used cases in Harvard on convertible bonds. And let me share that. As I told you, obviously, I cannot post it for copyright reasons. I cannot post this, but I can definitely display it for you, and I will be able to explain it. Most fascinating instrument in the market. And before I get to this case, can somebody explain what is a convertible bond, and has a convertible bond have been discussed in the class, both from a practitioner perspective as well as from the academic perspective? Does anybody know what a convertible
Yeah.
bond is?
Yes. Shell's
Okay.
class. Yeah.
Okay. Have you looked at the valuation? Okay. Oh, good. Very good. So tell us what is a convertible bond, and if you don't mind, tell us briefly what this case is about. Thank you very much for reading it. I appreciate that. So go ahead, Cliff. Yeah. Very good. Okay. So just for the benefit of everybody in the class, as Cliff correctly described, a convertible bond is basically a bond, but it is different from a straight bond in that the bond can be converted into a specified number of shares of stock of the issuing company within a certain specified period of time. Let me repeat. A convertible bond is a bond that can be converted into a specified number of shares of the issuing company within a specified period of time. So coming back to you, Cliff, is a convertible bond more or less attractive than an otherwise similar straight bond? So it is more attractive to the buyer of the bond and less attractive to the issuer of the bond. Okay, in some ways, I will agree. So if it is more attractive for the buyer, you are saying that it is more attractive to the buyer because the buyer has the advantage of converting that into the issuer's shares, right? And why is it not an advantage to the issuing company? Very good, because of the potential dilution, correct? Okay, now let me give you Okay, that's a good point. But let me point out another angle to you. Let's say it's a young company. So young companies have difficulty selling bonds in the market. Why? Because people may not actually trust the company. It's not seasoned. Just like you go to the bank, and if you have been working for only 2 years, bank trust you as much as they might trust me because I'm an old man working in the same job for who knows how long. So the point here is that young companies may have difficulty actually selling a straight bond in the market, which is why they are giving the option of the conversion to the bondholders. But there is another angle to this whole thing. Let's say that because this is a young company, let's say a heavy R&D company, where there is a lot of uncertainty about the future of the company. So the company might think that, you know what, the market still hasn't priced all of our potential. So the stock price is actually low today. Let's say that the stock price is 50. They think that in 5 years, the stock price may actually be 100. So if they can delay the sale of the stock 5 years, they might actually be able to sell the stock at 100. When a situation like that happens, the underwriter company might say that, you know what, delay the sale by 5 years by making this bond convertible at $100 5 years later. Does that make sense, Cliff? And that's exactly what they do. So this particular company is actually leading biotech company, as he correctly pointed out, had become an important client for Merrill Lynch, and Merrill Lynch is the one that is the underwriter here. $10 billion financing for Mogen in 4 years with proceeds raised totaling $10 billion. And here are the tranches. Now, every case I will urge you to please read totally. Obviously, I'm not going to be able to do that in the class, but here is the description of the convertible bond. A convertible bond was considered a hybrid security because it had attributes of both debt and equity. To illustrate, second paragraph, consider a convertible bond issued by Bio Inc. with a face value of $1,000 and a maturity of 5 years. Assume that the convert carries a coupon rate, meaning the bond carries a coupon rate of 4% and a conversion price of $50 per share. What that means is that if you convert, you will be converting it at $50 per share. That means that you will get 20 shares for that face value. If you do not follow anything at any point of time, please stop me. So it means that the company is telling the market that, look, this bond will be convertible to 20 shares of our stock. And the market immediately knows that 1,000 divided by 20, $50 is the conversion price. But notice that the market price right now is $37.50.
Expensive.
At the time of issuance. That means that the company is actually telling the market, obviously the market will not be converting now because the stock price is only $37.50 and they are paying $50 for it. So this is not convertible right now. Nobody is going to convert it. So the coupon payment gives an investor 4% is the coupon rate, $40 per share, 4% of 1,000, and an interest of 4%. And the conversion feature gives investors the opportunity to exchange the bond for 20 shares of BIOS common stock. Because BIOS stock was selling at $37.50 at issuance, the stock price would need to appreciate by 33%. 33% is $37.50 to $50, which is $12.50 gain, which is 33% of $37.50. 33% to reach the conversion price of 50. That means that the bond is being offered at 33% premium. That's where it is being issued. That means that the market, whoever buys the bond, will have to wait until the stock price appreciates by 33% before it is converted, or it is beneficial to convert. Now remember, there is 5 years for that. So 33%. For example, if bio stock price were to appreciate to 60 per share, investors could convert each bond into 20 shares to realize the bond's conversion value of $1,200. That means that you are going to get 20 shares as soon as you convert, all of which you can sell at $60 per share for $1,200. So you actually made $200 on that deal. On the other hand, if bio stock price failed to reach 50 within the 5-year period, the investor would not convert, but rather would choose to receive the bond's $1,000 face value. Because the conversion feature represented a right, remember the word, now we are saying that, hey, looks like it is very similar to the stock, to the call option. That means that the company has issued a call option with a 5-year maturity and an exercise price of 50 when the stock price is 37.50. So the convertibility option is basically a call option. That means a convertible bond is basically a straight bond plus a call option. So the way to value the convertible bond, as you will see next class, I will not be going through the valuation. I'll show you parts of it, and you will read it and you will go through my Excel spreadsheet. And by the next class, I think you will be very happy that, yes, I understand the whole thing. The first step is to value the conversion option. Because remember that I know the exercise price, which is 50. I know the stock price, which is 37.50. I know that T, which is 5 years. All I need to know is the risk-free rate. What else do I need to know? There are 5 things I need to know. What else do I need to know? Exactly, the volatility. So where would I get the volatility from? Somebody? Very good. Yes. Excellent. You can definitely look for the volatility of a similar stock. Now, of course, what is similar can be arguable, but the answer in principle is correct. Now, in this particular case, you don't really have to do that because there is other information given, which I will go through. So, because the conversion feature represented a right rather than an obligation, investors would postpone conversion as long as possible. That's what I was talking about, Cliff, that an American option will not be exercised. Why? Because you have the potential of the stock price going up even more, even if the bond was well in the money. Suppose, for example, that after 3 years, bio stock had risen to 60, investors would then be holding a bond with a conversion value of $1,200. That means that they can immediately convert the bond and get $1,200, rather not get 1,200, but 50 shares, which they can sell in the market, 20 shares, which they can sell in the market. Which is to say, if converted, that's exactly the point. Which is why you will see that that becomes a problem for the management, because the management now knows that, hey, we are sitting on this bond which is worth $1,200, but the face value is only 1,000. So my question to you, bingo, you said the word, so please go ahead. What callable means and why that is an essential feature on a convertible bond. Go ahead, Cliff. Yes. Exactly. And callability means that the company will call the bond. What that means is that the bondholders will be given the option either to convert or to surrender the bond. Now realize that if they convert at $60 per share, they're going to get $1,200. Whereas if they surrender the bond, they're only going to get the face value of $1,000. So by calling, the company can force the conversion, that investors will be forced to convert at that point of time. That's called forced conversion, which is why all convertible bonds are actually callable. So we know that in this particular case, the example that we are talking about, in a convertible bond, we will always know the conversion price and the conversion ratio. They are interchangeable. In this particular case, the conversion ratio was 50, rather 20, conversion price was 50. So the conversion price is 1,000 divided by the number of shares the bond is convertible into. That becomes the exercise price, $50. We know the strike price, stock price is $37.50. We know T is equal to 5 years. It is very easy to get the 5-year risk-free rate. Only thing we do not know is the underlying volatility. Now, in the interest of time, we may not have enough time to go through the whole thing. I will look at the data. But before I do that, let's look at the pricing decision, how they priced it. So if Manvi, this is the Merrill Lynch, so you should read all of this pricing decision as to the negotiations and all of that, could convince, by the way, the stock price on this company at that point of time was $77.98, could convince Mogen to accept a 25% conversion premium. So 25% on $77.98, if you take the 25%, it will become something like $95 or $97, something like that. Then choosing the coupon rate was the last piece of the pricing puzzle. If you do not understand what that means, is the following: that once they choose the premium, that means the exercise price for the underlying stock, they will immediately be able to actually price the convertibility. That what is the conversion value of this particular bond. Then the straight bond value will be 1,000 minus the conversion value. And then they can find the coupon rate. That's the whole pricing exercise. Now, I will explain this in more detail, which will possibly take the first half of the class, but let me show you something else. Here is the consolidated income statement. Here is this is the balance sheet. These are options that are trading on Mogen at that time. That means these are actually call options and put options that are trading on Mogen Inc. shares at that time. Bingo. That's the whole point. Because as I told you, that we know the stock price, $77.98. We know that the underwriter is actually suggesting to the company, set the exercise price 25% above that. So we know S, we know X, we know T, it's 5 years. And finding the risk rate is very, very easy. The only remaining thing is the volatility. And the volatility can be found from this data. So once you know the volatility, you can immediately find the price of the underlying call. Then you take that price, multiply it by the conversion ratio, that gives you the value of the convertibility option. The difference between that value and $1,000, which is the face value of the bond total, is the value of the straight bond From that, we can derive the underlying coupon rate. That's the whole pricing. So somebody can do the following. Notice that here is the stock price. You know that the exercise price right here, exercise price are given. You know the days to maturity. You know the price of the call. And the open interest and volume you do not really need. So this is your S. This is T. This is X. But we still need the risk-free rate. So let's go there. Here is the risk-free rate. Treasury bill, 1 year, 5 year, and 20 year. Take the 5 year. So you know S, X, T, risk-free rate. And then you can actually use the website that I showed you to actually back out the implied volatility from this. Now, there are 8 options here. And you will see that each of them will give you a different implied volatility, which is okay. You can actually you can actually take the average of those, but they are sufficiently close. Take that implied volatility, and then you can price the call option. That's the whole pricing model. Now, what's that got to do? What is this valuation model got to do with risk management? What it has got to do is that this is how companies can avoid the risk of having to issue a bond in an uncertain market, and also having to issue a stock which they think is valued. So when you have a situation where a young company wants to raise some money, cannot go to the straight bond market because they are not really well known, and does not want to issue share because the share they think is undervalued, this is one way that they can minimize the risk of issuing that particular straight bond. So this is neat financial engineering. There is no question about it. I will start next class with this model. Before I go today, I will take one more look at the option topics. And you will see I have covered almost everything excepting leveraging with options, which is a small example that is already given in your notes. You might review it, but I will go through it next class. So next class, before I get to the assignment for that class, which is the fixed income arbitrage, I will finish the option model, the Mogen Inc. convertible bond, and also the leveraging with options. Now, one of the things that I did not show you is this case. This one, option trading strategies. Now, let me actually share it. And this is definitely a case which I will urge the class to read, not entirely, but you will definitely be able to follow. And I will show you which parts of the case are really interesting. And all of these you already know: premium, maturity, strike price, underlying asset, option style, what kind of contract size. So this is a very informative one that tells you everything about options. Factors influencing, volatility, intrinsic value, movement, expiry date, interest rate, and dividends. Then option value sensitivity measures, delta, and all of that is explained here. Then I will jump to this. You can skip this part, tools for analysis, you don't really have to, but I will focus on this part. Option strategies. The reason I like it is because they actually classify strategies based on your view of the market. This is the only case that does it. So they are saying that if it is a bullish view, then you do a long call. Or you can do a bull call spread. Or if it is a bearish view, you do a long put. Also a short call. Remember, short call can be a hedge because the income that you make will offset some of your losses later. Or you can do a bear put spread. And then the most important one is the neutral view. That means you don't really know which direction the market is going to go. Short put is one, and short straddle is one. Short straddle is the opposite of long straddle. In a long straddle, you buy a long put and you buy a long call. In a short put, a short straddle, you sell both so that it is not a V, but an inverted V. And short strangle, I think I'll skip that. So if you just go through this, then it will be the butterfly and all that I showed you the picture. These are more complicated and not that popular. So that's what this particular case does. Event driven, meaning that there is an event coming, as Cliff told us, earnings or mergers is what I mentioned. That's where you do straddle. That you think there will be extreme volatility, but the direction is unknown. That's when you do the long straddle. This you do not have to worry about. Alternatives to trading options. The reason I'm showing you is to make sure you understand that, yes, we have gone through this already. And of course, all of these can be complemented with my own slides. And there are other stuff that I have. So next class, we'll start with Mogen Inc. and for a few minutes as to how you can use options for leveraging. Then we will pass to the arbitrage case with fixed income. Any questions? Of course, I will follow up with instructions as to the material for next two classes. And of course, I will do that definitely by this week because there is a lot of material to be covered in the next two classes. Any? Oh, what is that? Well, I've already actually given you the solution, but it will be good practice. Definitely, yes. But I will explain that spreadsheet to you. Yes. But you have already told us the procedure. The most key observation that you made is the one unknown factor there was the volatility. And you correctly identified what is that particular piece of information doing there with respect to why did they give us the quotations for the options. That was the most key observation that you made. So thank you for that. Before next class, if you want to form your own groups, please send it to me. Otherwise, I will do that. Not more than 3, or rather 4, but not less than 3. One group definitely will have 3 members. All right, folks, thank you very much and good night. I will see you next Tuesday. There will be other instructions about the next class and how to prepare. All of that will be done through email from me. And as I did yesterday, it takes about 2 to 3 hours for the recording to come to me. As soon as it does, I will either post it tonight or I will post it tomorrow morning. Enjoy the rest of the week and the weekend. I am putting the recorder on, stopping the recorder at this point of time.
Thank you.
All right.
So much.
Good night.
Thank you.
Thank you.
Bye.